You know what's fascinating? The mainstream financial media is still debating whether we're heading into a recession, while something far more significant is already unfolding right beneath their noses. By the time CNBC runs the headline, by the time Bloomberg sounds the alarm, it'll be too late for most people to position themselves properly. And I'm not talking about some theoretical future event. I'm talking about a fundamental shift in the global monetary system that's happening right now, in real time. Let me paint you a picture of what's actually occurring. While everyone's distracted by the latest Fed meeting or the newest inflation print, central banks around the world have been quietly accumulating gold at a pace we haven't seen in over 50 years. We're not talking about a few extra tons here and there. We're talking about systematic, aggressive buying that suggests these institutions know something the general public doesn't. The People's Bank of China has been adding to their gold reserves for 18 consecutive months. Poland just moved 100 tons of gold from the Bank of England back to Warsaw. Singapore's central bank has tripled their gold holdings. Turkey, India, Kazakhstan, Uzbekistan. The list goes on. These aren't random decisions made by unsophisticated players. These are calculated moves by some of the most powerful financial institutions on the planet. Now, here's where it gets interesting. When you dig into the actual mechanics of what's happening, you start to see a pattern that should concern anyone holding significant wealth in traditional assets. The COMEX, that's the major exchange where gold futures are traded, has been experiencing something unusual. The ratio of paper gold to physical gold has been expanding dramatically. We're talking about claims on physical metal that far exceed what's actually sitting in the vaults. Think about that for a moment. It's like a game of musical chairs where there are 100 people but only 10 chairs. Everything works fine until the music stops and everyone tries to sit down at once. Right now the music is still playing, but more and more players are starting to glance nervously at those chairs. I want to take you back to a specific moment in history because it's eerily similar to what we're seeing today. In the late 1960s, the London Gold Pool was operating under the assumption that they could control the price of gold through coordinated selling by central banks. The United States and 7 other countries were dumping gold onto the market to keep the price suppressed at $35 an ounce. They believed they had unlimited ammunition. They believed the system was stable. Then something unexpected happened. France, under Charles de Gaulle, started demanding physical gold in exchange for their dollar reserves. Other countries began to follow suit. The pool tried to hold the line, but the physical demand was relentless. In March of 1968, the London Gold Pool collapsed. Within 3 years, Nixon closed the gold window entirely. The price of gold went from $35 to over $800 by 1980. The people who understood what was happening before the mainstream media reported it. They positioned themselves accordingly. The people who waited for the official announcement? They watched from the sidelines as one of the greatest wealth transfers in modern history unfolded. Now, I'm not saying we're in exactly the same situation. The mechanics are different. The players have changed. But the underlying dynamics, the tension between paper claims and physical reality, that's remarkably similar. And there are some additional factors today that make the situation potentially more volatile. Consider the supply side of the equation. Global gold mine production has been essentially flat for years. The easy gold has been found. The ore grades are declining. It takes longer and costs more to bring new production online. Meanwhile, industrial demand for silver, which often moves in tandem with gold, has been exploding. Solar panels, electric vehicles, 5G infrastructure, all of these technologies require significant amounts of silver. We're talking about fundamental supply and demand imbalances that can't be solved with a press release or a policy change. But here's what really keeps me up at night: the derivatives market. There are trillions of dollars in interest rate swaps, currency derivatives, and commodity futures that are all interconnected in ways that even the regulators don't fully understand. When you have a system this complex, this leveraged, this dependent on confidence and smooth functioning, well, history shows us that these systems can unravel faster than anyone expects. Let me tell you about a conversation I had with a former COMEX floor trader. This guy spent 30 years in the pits, watching the daily flow of orders, understanding the psychology of the market. He told me something that stuck with me. He said, "The market can stay irrational longer than you can stay solvent, but when rationality returns, it returns with a vengeance." What he meant was this: prices can be suppressed, manipulated, or distorted for extended periods, but eventually physical reality asserts itself, and when it does, the snapback can be violent and swift. We saw this with the nickel market recently when prices went from $30,000 to over $100,000 per ton in a matter of days. The London Metal Exchange had to halt trading and cancel trades because the system couldn't handle the reality of the supply shortage. Now imagine that happening in the gold and silver markets, which are orders of magnitude larger and more important to the global financial system. The ripple effects would be extraordinary. Here's something most people don't realize. When you own gold or silver in a retirement account through traditional means, you don't actually own the physical metal. You own a claim on the metal. You own a promise. And in a crisis, promises have a way of evaporating. This is why more sophisticated investors have been looking at structures that give them direct ownership of physical precious metals within their retirement accounts. Quick aside here. If you're sitting on $100,000 or more in retirement savings, I put together a comprehensive guide on how gold IRAs actually work. It's in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, how the storage works, what the costs are, all the details you need to make an informed decision. Worth checking out if this is relevant to your situation. Anyway, back to what's happening in the markets right now. Because there's another dimension to this that we need to discuss. The geopolitical angle. And this is where things get really interesting. The BRICS nations, Brazil, Russia, India, China, South Africa, have been working on alternatives to the dollar-based system for years. But recently the pace has accelerated dramatically. They're not just talking about it anymore. They're implementing actual infrastructure, settlement systems that bypass SWIFT, trade agreements denominated in local currencies. And at the center of many of these discussions is gold. Russia and China have been particularly aggressive in building their gold reserves while simultaneously reducing their holdings of U.S. Treasury bonds. This isn't random. This is strategic positioning for a world where the dollar's role as the global reserve currency is diminished. Whether you think that's likely or not, the fact that major powers are preparing for that scenario should tell you something. Now, I want to be clear about something. I'm not predicting the imminent collapse of the dollar or the end of the financial system as we know it. What I am saying is that we're in a transition period, and transition periods are inherently unstable. They create opportunities for those who understand what's happening and risks for those who don't. Let me give you a specific example of how this plays out in practice. In 2008, during the financial crisis, there was a brief moment when gold actually declined in price. People who didn't understand the mechanics thought this meant gold wasn't a safe haven. But what was really happening was a liquidity crisis. Institutions needed cash immediately to meet margin calls, so they sold whatever they could sell, including gold. Within months, gold began a sustained rally that took it from around $700 to over $1,900. The people who panicked and sold during that initial dip missed one of the greatest bull runs in gold's history. The people who understood the difference between a liquidity-driven sell-off and a fundamental change in value, they accumulated during the panic and profited enormously. We might be approaching a similar moment. The signs are there if you know where to look. Credit spreads are widening. Volatility is increasing. Central banks are trapped between fighting inflation and supporting economic growth. The Treasury market, supposedly the safest, most liquid market in the world, has been showing signs of stress. Here's a question I want you to consider. What happens when the rest of the world loses confidence in the dollar's purchasing power? Not completely, not overnight, but gradually, persistently, irreversibly. What happens when oil-producing nations start accepting payment in currencies other than dollars? What happens when China's Belt and Road Initiative creates an entire economic sphere that operates outside the dollar system? These aren't hypothetical questions anymore. These are things that are actively happening. Saudi Arabia is now accepting yuan for oil sales. The UAE is settling trade in rupees and dirhams. Indonesia and Malaysia are discussing local currency settlements. Each of these developments, taken individually, might seem insignificant, but collectively they represent a fundamental shift in how global trade operates. And here's the thing about fundamental shifts. They happen slowly, then all at once. For years, nothing seems to change. The system appears stable. The status quo persists. Then suddenly, seemingly overnight, everything is different. The Berlin Wall stood for decades until it didn't. The Soviet Union seemed permanent until it wasn't. Lehman Brothers was too big to fail until it failed. I'm not trying to be alarmist here. I'm trying to be realistic about the forces at play. And one of those forces is the simple mathematics of debt. The United States has over $33 trillion in federal debt. The interest payments on that debt are now exceeding defense spending. That's not sustainable. Something has to give. Historically, When governments find themselves in this position, they have three options: default, austerity, or inflation. Default is politically unacceptable. Austerity is politically unpopular. That leaves inflation, the slow, steady devaluation of the currency. And what's the traditional hedge against currency devaluation? Physical precious metals. This is why central banks are buying gold. This is why sophisticated family offices are allocating to precious metals. This is why billionaires like Ray Dalio and Stanley Druckenmiller have been vocal about the importance of gold in a portfolio. They're not doing this because they're pessimists or doomsayers. They're doing this because they understand monetary history and they can see where this is heading. Let me share another historical parallel that's relevant here. In the 1970s, we had a similar situation: high inflation, loss of confidence in the dollar, geopolitical instability. Gold went from $35 an ounce to over $800. But here's what's interesting. The real gains weren't made by the people who bought at $35. Most people didn't recognize what was happening at that point. The real gains were made by the people who bought anywhere between $100 and $300 after the trend was established, but before the parabolic move. We might be in that zone right now. Gold has been consolidating, building a base, while the fundamental drivers continue to strengthen. The mainstream hasn't fully caught on yet. CNBC isn't running breathless coverage. Your neighbor isn't talking about it at barbecues. But the smart money is positioning. And it's not just about gold. Silver has its own unique dynamics that make it potentially even more explosive. The gold-to-silver ratio, that's how many ounces of silver it takes to buy 1 ounce of gold, has been historically high. Right now it's hovering around 80 to 1. The historical average is closer to 50 to 1. In previous bull markets it's compressed to 15 to 1, or even lower. What does that mean in practical terms? It means that if gold goes up 50%, silver could potentially double or triple based on historical patterns. This is why many investors use silver as a leveraged play on the precious metals thesis. It's more volatile, but that volatility works both ways. Now let's talk about the elephant in the room, the paper market versus the physical market. This is crucial to understand. When you see the price of gold quoted on financial websites, that's primarily the price of paper gold, futures contracts, ETFs, derivatives. These are claims on gold, not actual physical metal. And the amount of paper gold trading hands dwarfs the amount of physical gold that actually exists. This creates an interesting dynamic. As long as everyone is content to trade paper claims, the system works fine. But if a significant number of participants start demanding physical delivery, the system breaks down. We saw a glimpse of this during the early days of the pandemic when premiums on physical gold and silver coins spiked dramatically above the spot price. Dealers couldn't get inventory. Mints were running at full capacity and still couldn't meet demand. The paper price barely moved, but try buying physical metal at that price. It was impossible. That disconnect between paper and physical is a warning sign. It tells you that the price discovery mechanism is broken. It tells you that the real supply and demand situation is different from what the official price suggests. And it tells you that when the system resets, and it will reset, the adjustment could be dramatic. I want you to think about your own financial situation for a moment. How much of your wealth is denominated in dollars or dollar-based assets? How much is in the stock market, which is priced in dollars? How much is in bonds, which are promises to pay you back in dollars? How much is in real estate, which is typically financed with dollar-denominated debt? For most people, the answer is almost everything. Their entire financial life is a bet on the continued stability and purchasing power of the dollar. Now, maybe that's a good bet. Maybe the dollar will remain strong and stable for decades to come. But what if it's not? What if we're in the early stages of a significant devaluation? What's your plan B? This is where precious metals come in. They're not about getting rich quick. They're about preserving purchasing power across time and across different monetary regimes. Gold has been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, and every other crisis you can imagine. It's the ultimate insurance policy. But here's the critical point. Insurance only works if you buy it before you need it. Once your house is on fire, it's too late to call the insurance company. Once the currency crisis is obvious to everyone, it's too late to position yourself advantageously. The time to act is when things still seem relatively normal, when the mainstream is still skeptical, when you can still acquire physical metal at reasonable prices. Let me tell you about what happened in Venezuela. For years, people there thought their situation was temporary. They thought the government would fix things. They thought the currency would stabilize. They waited for the news to report that things were getting better. Instead, things got worse. The bolivar collapsed. Hyperinflation destroyed savings. People who had been middle class found themselves unable to afford basic necessities. But there was a small group of people who saw it coming. They converted their savings into gold and silver. They moved their wealth into hard assets. When the crisis hit, they were protected. They could still buy food. They could still pay for medicine. They could still maintain their standard of living while everyone around them was devastated. I'm not saying the United States is Venezuela. The situations are different in many ways. But the principle is the same. By the time the crisis is obvious to everyone, it's too late to protect yourself. The time to act is now, while you still can, while physical metal is still available, while premiums are still reasonable. And here's something else to consider: the opportunity cost of being wrong. If you allocate a portion of your portfolio to precious metals, and I'm wrong about all of this, what's the downside? Gold and silver have intrinsic value. They're not going to zero. You might underperform the stock market for a while. That's the risk. But if you don't allocate to precious metals and I'm right about the direction we're heading, what's the downside? You could see a significant portion of your wealth evaporate in real terms. Your purchasing power could be cut in half or worse. Your retirement plans could be derailed. That's a much more serious risk. This is what risk management is really about. Not trying to predict the future with certainty, but positioning yourself so that you can survive and thrive regardless of which scenario unfolds. It's about asymmetric risk-reward. Small allocation, large potential benefit, limited downside. Now, I want to address something that comes up a lot: the argument that gold doesn't pay interest or dividends. This is true. Gold just sits there. It doesn't generate cash flow. But here's what people miss. In an environment where real interest rates are negative, where the interest you earn is less than the rate of inflation, cash flow doesn't matter. What matters is preserving purchasing power. If you're earning 2% interest but inflation is running at 5%, you're losing 3% per year in real terms. You're getting poorer even though your account balance is going up. Gold doesn't have this problem. It maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same about the dollar? Let me give you a concrete example. In 1920, a quality men's suit cost about $20. An ounce of gold cost about $20. Today, a quality men's suit costs about $2,000. An ounce of gold costs about $2,000. The purchasing power has been maintained. Meanwhile, if you had kept that $20 in cash, it would buy you almost nothing today. This is the power of hard assets in an inflationary environment. They're not about making spectacular returns. They're about not losing. And in the long run, not losing is how you win. Here's another factor that's often overlooked: the psychological aspect of owning physical precious metals. There's something tangible, something real about holding a gold coin in your hand. It's not a number on a screen. It's not a promise from a bank or a government. It's actual wealth that you can see and touch. In times of crisis, that psychological security is worth something. I've talked to people who lived through the collapse of the Soviet Union, through the Asian financial crisis, through the Argentine peso crisis. Almost universally, they say the same thing. The people who had physical gold and silver were able to navigate the chaos. They could bribe officials if necessary. They could buy food on the black market. They could preserve their wealth when everything else was falling apart. Now, I'm not predicting that level of crisis in the United States, but I am saying that having some physical precious metals as part of your overall wealth strategy is prudent. It's a form of diversification that goes beyond just having different stocks or bonds. It's diversification into a different asset class entirely, one that has proven its worth over thousands of years. The question isn't whether you should own some gold and silver. The question is, how much and in what form? And that depends on your individual situation, your age, your wealth level, your risk tolerance, your other assets. But as a general principle, having 5 to 20% of your investable assets in precious metals is a reasonable starting point for most people. And here's the thing: you don't have to go all in. You don't have to bet the farm. You can start small and build your position over time. Dollar cost averaging into precious metals can be an effective strategy, especially if you're concerned about timing the market. Buy a little bit each month or each quarter. Over time, you'll build a meaningful position without having to worry about whether you bought at the top. But the key is to start. Don't wait for the perfect moment. Don't wait for prices to drop. Don't wait for confirmation from the mainstream media. By the time everyone agrees that precious metals are a good idea, the easy gains will be gone. The time to act is when it's still contrarian, when people are still skeptical, when you can still acquire physical metal without paying huge premiums. Look, I understand the hesitation. I understand the skepticism. We've been conditioned to believe that the system is stable, that the dollar is sound, that the government and the Federal Reserve have everything under control. And maybe they do. Maybe I'm wrong about all of this. Maybe the next decade will be smooth sailing with low inflation, strong economic growth, and stable currencies. But what if I'm not wrong? What if we're in the early stages of a major monetary transition? What if the warning signs that are visible right now, the central bank buying, the geopolitical shifts, the debt dynamics, the supply constraints, what if these are the early indicators of something much bigger? The people who will benefit from this transition are the ones who are positioning themselves now, before it's obvious to everyone. The people who will suffer are the ones who wait for certainty, who wait for the news to report it, who wait until it's too late. Don't wait for the news to report this. By the time they do, it will be too late. The opportunity to position yourself advantageously will have passed. The premiums on physical metal will have spiked. The availability will have dried up. The easy gains will be gone. The time to act is now, while you still can, while physical metal is still available at reasonable prices, while you can still make rational decisions without the pressure of a crisis. This is your moment. This is your opportunity. Don't let it pass you by.